Thank you for attending this Quantitative Disclosure Summary presentation. I am Kawai in JSCC's Clearing Planning Department, and I will be leading today's call. Today's meeting will be around 30 minutes, starting with an overview of this quarter, followed by the topic of this quarter, and then a briefing on the major risk points. Finally, we will try to address as many of your questions as possible within the schedule. On this webinar, as a special topic for this quarter, we will present a global drill that simulated the default of a large-sized financial institution. All of the meeting attendees will be on mute, but if you have any questions, please let us know using the Webex Q&A function. To begin with, Mr. Miyauchi, JSCC's CRO, will give an overview of the quantitative disclosure from Q3 2023.
Thank you. JSCC keeps 71 billion yen of skin in the game, which is the same as the previous quarter, mostly from JSCC's own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 79% of JSCC shareholder equity. During this quarter, stress test breaches, where the risk amount in extreme but plausible market conditions exceeded pre-funded resources, were observed on 2 days for cash securities clearing service, 2 days for JGB futures and option clearing service, 1 day for precious metal OSE clearing service and rubber clearing service, and 8 days for the energy clearing service. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin back testing for the past 12 months, the cover ratio was comfortably within JSCC's targets, 99.5% for IRS and CDS, and 99% for other products. And you will note that the cover ratio for IRS has now recovered to a level that is within the target. There were neither liquidity stress testing breaches nor any participant default during this quarter. JSCC experienced no suspension of the clearing services during the past 12 months period. Now I will pass back to Ms. Kawai.
Thank you. Page 7 is the topic of this quarter, a global fire drill that simulated the default of a large-sized financial institution. JSCC recently participated in a global fire drill along with major CCPs in other countries to simulate the default of a large-sized financial institution. The drill took place from November 13 to November 20, 2023, and in Japan involved the participation of the Financial Services Agency, the Bank of Japan, and 52 financial institutions, including banks and securities companies. It was the first drill initiated by CCP Global, the International Association of CCPs globally. Overall, 31 CCPs participated. The purpose of the drill was to test and strengthen the default management functions of each participating CCP, aiming to prevent the spread of contagion from a member institution's default to other market participants. This coordinated simulation marked the first time that key global CCPs had simultaneously conducted a default settlement drill, simulating the default hypothetical global financial institution. Page 8 shows the outline of the drill timeline at JSCC. JSCC had previously established a robust default settlement framework to manage the default of a financial institution participating in the clearing of listed or OTC transactions. JSCC's framework is designed to manage the disposal of collateral posted by a defaulted clearing participant as well as liquidating its unsettled position to prevent any impact on other market participants. JSCC drill took place smoothly, and we plan to consider any findings and insights gained from this global fire drill as we do from the regular fire drills that we hold at least annually for each clearing services. Now, back to the PQD. Page 9 is an introduction of JSCC's service structure. Clearing services are divided into 14 categories according to the governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. Page 10 shows financial resources for participant default called skin in the game or SIG, and contributions from relevant exchanges and PTSs. Most of the exchange contribution is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. As shown in the left-hand table, JSCC's skin in the game for ETP non-commodity was 20 billion yen, which is shared by all of the relevant clearing categories. The right-hand table shows compensation by exchanges and PTSs. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared sources according to the relevant default fund amount for each category. Page 11 shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund or DF, and the right-hand graph shows the skin in the game to be used before the default fund plus alongside default fund of defaulting participants on a pro rata basis. Skin in the game before default fund on the left ranges from 18 to 50% of shareholder equity, and skin in the game before and alongside default fund on the right is from 34 to 99% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which shows our strong commitment to risk management. Page 12 shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this page shows the ratio of skin in the game and the contributions from exchanges to default fund from members. Default fund for ETP commodity jumped to 20 billion yen from 11 billion yen as a result of the expansion of position on the large participants for precious metal and energy. On page 13, the data is listed for these graphs, and the amount of potential assessment, or so-called cash call, is also provided. As stated in the footnote, the cash call for any ETD is capped at 3 times the default fund requirement, and for OTC products, it is capped at 1 time the default fund requirement. Page 14 shows KCCP. The increase in the FIEA-regulated KCCP was mainly caused by an increase in the Nikkei 225 index. Moving to stress testing, page 15 shows the largest value and mean value of the SLOIM, which is the stress risk amount exceeding initial margin deposited including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund on page 12 is the value at the end of the quarter, but the SLOIM on page 15 is the largest or mean value during the past 12 months period. JSCC's default assumption is cover 2, except for any listed commodity derivatives other than OSE Petroleum, which is the largest one plus the 5 smallest firms in the net asset. Among all clearing service categories, ETP Index Futures Option had the largest volume, with a peak value of 450 billion yen. Volume for OTC JGB decreased significantly from beginning of 2023. This was due to the largest historical volume values gradually falling out of the 12-month scope. Page 16 shows the number of days there was a shortfall in the stress testing of pre-funded resources and the largest shortfall. Breaches were observed on 2 days for cash securities and JGB futures and options, 1 day for precious metals OSE and rubber, and 8 days for energy. But these breaches were mainly due to the expansion of positions by the largest participants, and all were resolved on the next business day through the requirement for additional collateral. Page 17 shows the required and excess initial margin amounts. The dark blue is the house initial margin requirement, and dark orange shows clients. Light blue is the excess margin for house accounts, and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC JGB were the largest at between 1.5 to 2.6 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on page 17 is shown on page 18 and 19. Moving to initial margin backtesting, page 20 shows the number of breaches in IM backtesting for the past 12 months period. The upper chart on page 21 shows the largest breaches in the past 12 months, which were about 15 billion yen for ETP JGB futures and options, 19 billion yen for IRS, and 62 billion yen for OTC JGB. This test only looks at the base IM requirement without add-ons. JSCC has confirmed that these breaches would have been covered by resources such as IM add-ons, excess IM deposit, or skin in the game, and the whole amount of the default fund would have remained almost untouched. The lower chart of this page shows the largest breaches in the past 3 months. JSCC started disclosing the figures on qualitative notes sheet of our disclosure from Q4 2022. The upper chart on page 22 shows the quarterly largest value of variation margin, or VM, paid to JSCC, and the lower chart shows the largest value of IM gold during each quarter. Please note that while VM needs to be deposited and settled in cash, IM may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. Page 23 and 24 show the composition of collateral used for IM deposit. On page 23, you can see that the majority of ETP IM was cash, as shown in dark blue and dark orange, but some was in JGB and stocks shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposited at commercial banks, in dark orange, was held in settled account of commercial banks, which were fully covered by the Japanese Deposit Insurance Scheme. On page 24, you can see that the majority of OTC IM was deposited in cash, but with some JGBs. Deposit of stocks are not allowed for these OTC categories. The entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e. Japanese trust account, or the central bank account in the name of JSCC. The secured cash deposited at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from the bankruptcy of JSCC as well as the participant. Page 25 separates cash deposits into those for initial margin and default fund. We are holding a total of about 8.9 trillion yen of cash collateral across all the categories. Next, page 26 shows the custodian for this cash collateral, with almost 100% held in either the central bank account, settlement accounts covered by deposit insurance, or the trust scheme. Page 27 covers liquidity risk management. Please note JSCC's liquidity risk appetite is cover 2, but this data is presented based on cover 1, in accordance with the PQD guidance. And while JSCC separately calculates and manages default funds by category for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquidity financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least a half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment, because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. So we do not regard such collateral as available liquidity resources. Page 28 shows the liquidity resources for the categories other than OTC JGB. The resources reported as cash at the central bank on the first line and secured cash at commercial banks on the third line include cash in the DF related to ETP, where at least 50% of the required DF minus 1 billion yen must be in cash. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available for JSCC's parent company and multiple commercial banks that have been designated as fund settlement banks and total to more than 1.5 trillion yen. Now we will move on to Q&A. If you have any additional questions, please let us know using Q&A function. Well, the first question we received is that will the global fire drill be conducted on an annual basis from next year onwards? Thank you for your question. The frequency of the next and subsequent editions of the global fire drill is currently under discussion with CCP Global and other relevant parties and has not yet been finalized. JSCC has been conducted to fire drills individually on an annual basis and will continue to do so in the future. Well, next question, second question is that we receive is, did you see any impact on the cover ratio of ETD after JSCC introduced BAR as the margin calculation methodology in November? Oh, thank you for question. Well, BAR was only implemented in November, and we hope to be able to report back at the next briefing on the Q4 2023 quantitative disclosures, which will be for end of December 2023 data. This data will be published at the end of February 2024. Having said this, we are expecting to see an improvement in the cover ratio.
And the next question is about the slide 15. The question is regarding the graph on top right hand corner on slide 15. Could JSCC please comment on the decrease in peak stress exposure at JGB-OTC from 357 at Q4 2022 to 165 at Q3 2023. Has there been any change to stress testing scenario over the year? Okay, the answer is we have not changed stress testing scenarios over this year. This was due to the largest historical throwing values gradually falling out of this 20-month scope. So I mean the last biggest throwing was happened 1 year ago. So now the figures gradually decrease. Thank you for your question.
Well, any additional question if you have? So now, no more questions we received in WebEx Q&A box. So, well, with that, I would like to wrap up today's webinar. Well, please do not hesitate to contact us if you have any additional questions after the call. Just for your information, you can find today's material, recording of past webinar, as well as the minutes of QA sessions at the same page of PQD data on our website. So please visit our website if you're interested. Thank you for your time again. We look forward to posting next webinar and speak to you soon. Thank you.